So now for today's strategy session, and you can see from the chart on your screen right now, the ratio of tech stocks relative to the S&P 500 is actually at its highest level that we've seen since the dot-com bubble, as valuations for those mega cap companies sit at record highs. So valuations and earnings expectations at such high levels, could we potentially be due for a sell-off? Let's bring in Marta Norton, Empower Chief Investment Strategist. Marta, it's great to have you here on Yahoo Finance. Let's talk about maybe what this signals, the margin for error. I think maybe that's the question here. The margin for error this earnings season, is that very small, just given maybe the negative reaction we could see to any sort of shortfall?
Yeah, it seems as though with expectations being so high, and these numbers are widely cited, but earnings expectations for the first quarter around 11%. And then as you ramp up over the course of the year, you're looking at about a 15% earnings growth. Those are really high expectations relative to history. And you're pairing that with valuations that also seem really stretched. And so we're looking at this on a price to expected earnings basis. So incorporating some of those earnings expectations. And even on that metric, you're looking at a market that is in the 10th decile in terms of, historical valuation ranking. That doesn't necessarily mean a sell-off is imminent. Valuations, can remain high, markets can grind higher, but it becomes more and more of a risk and kind of raises the possibility of a sell-off with that little margin of error that you suggest there in terms of execution or disappointment.
And so with that in mind, if we did get a reset of some of those expectations, at least early on in the year, do you anticipate that sell-off that we could see might turn into a full-blown correction?
Well, I think that possibility is out there. What gives me some encouragement about this market is when we're taking a look at the economy, and I know we're on pins and needles as we, follow inflation very closely here. But broadly speaking, the economy seems very healthy. There are stimulants out there when we're thinking about different fiscal policy, when we're thinking about the possibility, if inflation comes under control, of lower rates. So there's a lot of positives to point to that could suggest that we're in a healthy place. The one concern is where sentiment is and disappointments on that sentiment and what that could mean. But in terms of fundamental weakness, that could mean some sort of collapse in markets and some sort of recession. That seems a little bit further afield for me.
Marta, I'm curious what you've made of the reaction that we've seen over the last 24 hours, how the market was quick to dismiss some of those inflationary concerns, and we really saw that reaction play out within the bond market. What does that tell you maybe about the volatility that's ahead?
I mean, it just feels like pins and needles. And frankly, it's a continuation of the trends that we've seen over the past year or so. So if you remember, starting into 2024, the expectation was that inflation was falling like a rock and we were going to get plenty of cuts. Then inflation disappointed to the upside. Fears commenced around inflation. Then we have fears turn to labor. The economic narrative has been shifting consistently, and investors have been following suit. And I think the reaction that we're seeing today is very similar to this high-strung nature that the market has demonstrated over this time. I think it's really important to step back and look at this broader mosaic where I think we're seeing a cooling labor market despite month-to-month volatility, and we're seeing inflation traverse that very difficult last mile to that 2% target. So I think that broader mosaic is still entrenched, but the day-to-day volatility and narrative shifting is going to remain something that we have to contend with.
We're, of course, just days away from the inauguration, and it seems like the Fed is going to be in wait-and-see mode to see how policies might get enacted, whether that looks like and comes in the form of tariff policy, whether that comes in the form of some type of immigration and deportation that was campaigned on that gets carried through. All of these have economic implications, and ultimately, we're trying to get a playbook for investors and how they should be approaching all of those key events if they were to play out as campaigned on, at least. How are you looking at that?
Right. It's complex and it's uncertain. And I think that's one reason why we're seeing the bond action that we're seeing. There's a major redirect from Biden policy where most of these policies outside of the protectionism embedded in tariffs are moving in the opposite direction. But there's a question on what that magnitude looks like. And so I think what investors are really trying to grapple with as we see the inauguration and policy established is what that magnitude looks like. And I think the uncertainty there is pretty high around around a number of factors. Take taxes, for example. That feels like an obvious direction that the Trump policy is heading in, but we don't really even know exactly what can be accomplished given the small majority that we have in the House. And so I think that there's a lot of assumptions with not a lot of information around some of these policies. Now, tariffs seem a little bit more evident that that's going to come into play, but we don't know whether that's going to be a slow and steady approach, whether that's going to be a big bang phenomenon, or whether we're going to have a universal tariff or targeted tariffs. So I think that is one of the things that keeps the market on pins and needles right now.
All right, Marta, thanks so much for joining us here this morning. Marta Norton of Empower.